not all gold stocks are equal, and some of them are what I describe as probably lower risk, and others are incredibly risky. So if you're looking to make a lot of money, you probably don't want to have all your money in the lowest risk. But similarly,
ladies and gentlemen, welcome to the special interview. Today we have a returning guest to the show, Simon Popple. Simon runs BrookvilleCapital.com, the Brookville Capital newsletter. And I got to tell you, after this interview, we're going to be presenting some valuable information that you're going to want more of. And you can go over to Brookville Capital. Links will be in the description below to get more of this valuable information, because people are going to want to start taking action. And Simon's independent analysis provides actionable information to help traders, investors alike make these decisions. Simon, thank you again for joining us today on Silver Doctors.
Lovely to be here.
Now, Simon, Brexit, totally misunderstood, one of the most important things affecting the markets today. The reason why I say that is because June 24th, 2016, the vote was held. In dollar terms, on the COMEX, gold traded, it opened at $1,254 and it hit an intraday high that day of $1,362. We had over $100 pop in gold. Brexit matters for the metals in the markets. Here's the thing though, people don't really understand what Brexit is. Now we're not talking about Theresa May, we're talking about Boris Johnson. And the vote was a couple years ago. So if you could just bring us up to speed, Simon, what is Brexit? Who is Boris Johnson? And where do things stand today?
Well, yeah, there's some fairly big questions there. I mean, I think the Brexit situation is quite well summed up, not just with the gold price, but also the pound. Because if you look at what's happened to the pound, especially recently, it really has suffered against all the major currencies. And so, I think this underlies the fact that no one really knows what Brexit is. I mean, Theresa May famously said Brexit means Brexit, but that doesn't really sort of give people much of an idea as to, what could happen. And, there's talk of, a soft Brexit where we keep some of the relationships we have with the EU, or a hard Brexit where, we sort of walk away and set things up under a World Trade Organization type structure. And I think that's it's the fear of the unknown. And out of that fear of the unknown, people are turning to the yellow metal and other kind of physical assets, because they've got global appeal. And I think that's something that people are kind of latching onto. Anything that's got a sort of appetite beyond our borders is something that perhaps makes sense to have at least some in their portfolio.
Do you know if there's also risk with the pound sterling when it comes to the IMF SDR, or is there not talk about that far ahead of things just yet?
Well, I think we're some way off sort of knowing where we are, to be honest. I think we would obviously want the pound to be part of the SDR. It would be crazy not to want that. But I think one of the problems that the UK has at the moment is there's talk of a recession happening, and we're sort of mid-August, and we won't know where we are until the end of October. And so there's an awful lot going on behind the scenes in terms of talk of recession and all the other things that are happening in the world. But the UK is just so focused on Brexit, and I think the only takeaway we can take at the moment is what's happening to the pound.
Those are very excellent points. And similarly, on this side of the pond, everybody is so focused on the trade war and the currency wars. But it's also this big unknown. Is there going to be a deal? Is there not going to be a deal? How long is this going to take? It's been going on for a couple of years now. So I think that we're starting to see a lot of these factors coming to play. And I think that is helping put the bid under gold and silver here. Now, I don't know if these things can drag out for many more years, but it's clear that gold and silver have in fact broken out. So I wanted to spend some time today talking about, when it comes to the safe haven bid for gold, do you see people rushing into other things as well, such as, because people talk about the U.S. dollar and the U.S. bond market as a safe haven, but I'm thinking that if there's problems with currencies around the world, for example, today we also have the Argentine peso that's in chaos. Maybe people aren't going to be seeking the safety of traditional government paper, and maybe there will be even more of a bump into gold and silver. I don't even know if that made sense, but those are just some of the things that I'm thinking about because, over there, you guys have an issue that's been dragging on for a couple of years. Here we have an issue that's been dragging on for a couple of years. And we have fiat currencies that are pretty much in crisis mode right now. Any additional thoughts you could add to that there, Simon?
Yeah, absolutely. Well, I mean, if you look at, bond yields, across the world, I mean, they are either very, very small or negative. And, one of the big pushbacks about gold is the fact it doesn't yield anything. And I think that what people are realizing is that we've got massive global debt, corporate and sovereign, and typically when you have a downturn, recession, call it whatever you want, people sort of switch from equities into debt, and it's a tried and tested way. People have done it for decades and decades, but with debt so high and yields so low or non-existent, I think that people are, at least thinking about, where they could allocate some of their money. Not all of it, but just some of it. And a lot of people have got literally nothing in gold and silver. And I think that even if they were to sort of put 1% or 2% of their portfolio into a physical asset such as gold and silver, it would have a profound impact on the price.
And that just makes me think about how, one of the reasons that the dollar seems like it's been in this sideways channel for the better part of years, because yields have been a little bit higher here, but we see that the Federal Reserve has recently reversed course, and now we're starting to reduce our interest rates after we were supposedly tightening. So I find that interesting that whereas before people were looking for those, if there's more downward pressure on interest rates here in the United States, because we know a lot of places in the Eurozone already have negative interest rates, such as Germany, for example. So that could also provide additional movement into gold. So here's where I would like to take the interview, Simon, because this is one of my concerns, because we saw this in 2016 when gold and silver started taking off. And what we saw in 2016 was a lot of interest into the mining sector. And people made a lot of money in the mining sector, and people also lost a lot of money in the mining sector and wrote it down. Because they went on a spectacular run, and then I think it was like August or September of that year when gold and silver corrected and the miners corrected, and then it was 2 more years of misery, if I could call it that. So here's my thing, and here's my question for you. Because we know people are going to start looking for things other than just gold and silver. They're going to want to look at the profit potential with the mining sector. So how is it that people can get a grasp on learning about, the mining sector in general? Like, what are some of the things that you do? Do you look at just the fundamentals? Are you digging into companies' balance sheets? Are you looking at technical indicators? How important is it to get a solid understanding of the miners if people are interested in the excitement and the action that's about to come into the sector?
Well, I mean, I think it's a bit like a jigsaw, that there's many different parts to having success investing in the sector. First of all, you need to pick the right mining stocks. And I'm not sure what you have in the US, but over here we have what we call fantasy football, where you pick a team for the season. You perhaps have that in the NFL or whatever it is. But I think if you're investing in the sector, then what you need to think about is having the right team, and that is not having purely forwards. Let's call them explorers, very high risk plays. What you want is a mixture of forwards, midfielders, defenders, and goalkeepers. So I put the goalkeepers at the kind of lower risk of the spectrum, and so they're probably your established majors. And then you've got other producers, and then your midfielders are probably your new producers, and then you've got your explorers, which are the ones that in the last boom in the 1970s, some stocks went up 10, 50, 100 times. But I think what people need is a strategy. You've got to have a strategy if you're investing in the sector, because if it takes off, then people think that they're investing experts because they can buy in at perhaps 50 cents and then sell out at 100 cents and go whoopee-doo, I've doubled my money. But then the stock can continue to go upwards, and they'll buy back in at 3 and sell out at 4 and think they've done really well. So they really need to have a strategy, and I think the biggest mistake people make, and I made it myself in the last boom, was you sell one gold stock and you then go and buy another gold stock. And if you selected the right ones at the outset, then you can have a bit of clarity on what you want from that stock. And once you've hit that target, the best thing to do is to sell and put the money somewhere else, i.e. not back into the gold sector. I think that's really critical for succeeding, because what happened in the last sector is perhaps someone allocated, I'm pulling numbers out the air here, but let's say $100 to investing in the sector, but they made so much money in the first couple of years, they thought, well, let's put $500 in, and then the market turned, they lost it all, and so they lost way more than they were initially thinking of deploying in the sector. So if you've got a strategy, and that's where the newsletter is actually quite important, because having the right stocks is only part of the jigsaw. You then need to have the strategy, and you mentioned the Argentinian peso. I mean, one of the stocks that I write about has got a major mine operating in or about to operate in Argentina. So I put a sell note on that last night, because you need to be quite nimble. Things happen in the market that you can't predict, and so when they do happen, you need to sort of quickly adjust your team and sell a player and perhaps bring another player in.
Yes, and to add on top of that, one of the things that I am understanding from you, that it sounds like to me, because we talk about having a core position in gold and silver. I think you had just mentioned 2% as a possible place to start for a portfolio allocation to gold and silver. But it also sounds like what you're telling me with the miners is that you would also want to have kind of like a core position in the majors, almost like a small percentage of that trading account or that investment brokerage statement in the majors, and then you can use the smaller mid tiers or the explorers for kind of like a speculation. Is that kind of what I'm hearing from you there, Simon?
Yeah, absolutely. I think that you need to make sure that whatever you're doing works for you, and you need to perhaps speak to your financial advisor and work out how much risk you want to take, because not all gold stocks are equal, and some of them are what I describe as probably lower risk, and others are incredibly risky. So if you're looking to make a lot of money, you probably don't want to have all your money in the lowest risk. But similarly, you don't want to have a team that's full of strikers or quarterbacks, because you need a blend. And I think that one of the problems people have perhaps in the market is they don't know whether they've got defenders, midfielders, or strikers or forwards. And so if they make 2 or 3 times on one stock, they think they've done phenomenally well and they'll sell out, only to see that make 5, 10, 15, 20 times the value they could have made. Or they may hang on to a more established major that's doubled, and perhaps at that point they should be thinking about getting out.
And just to reiterate, you're not you're not employed by a mining company or anything like that. So your views on this is completely neutral. You're just saying, here's this stock and here's what I think about it. Is that correct, Simon?
No, that's absolutely right. I mean, I have been approached by mining companies to say, we can pay you a fee and then you can ride us up, but we just don't do that. I mean, basically, I personally invest in all the ideas that I present to people, because I think it's important for me to have skin in the game. And Also, I mean, like yesterday, I sent out a note saying I wanted to sell, and then I waited, and then I sold. So I give people an opportunity to do things before me. But yes, it's completely independent, and I think that's really important, especially in the sort of junior sector, because you've got some very small companies, and you should only really invest in them if you feel there's a really compelling situation.
Now, there's a couple factors here when it comes to the mining sector, and one of the factors is, what are the costs of the mining company? What are they paying out versus what are they bringing in? How much are they producing? But another one of the costs is related to the gold and the silver price, in that the value of a company can increase if the gold and the silver price is rising. Can you? So I guess the question is, could you explain some of the dynamics of how value in a mining company is, and what does a rising gold or silver price say to the value of mining companies in general?
Absolutely. Well, I mean, I think that's one of the interesting aspects of the sector, really, because with more traditional companies, they probably got more control over their alpha, what new products are bringing to the market and things like that. Whereas with a mining company, on the one hand, they've got control over their exploration budget, but they don't have control over their exploration results. So, in terms of what's the key driver behind the price? I mean, you're absolutely right. The gold and silver price are incredibly important, but especially for producers, because they've got a defined reserve or resource. So it's easier for analysts to say, right, this is their reserve, this is their costs, and this is the gold price or silver price. So we think that they can generate this sort of cash flow over the life of the mine, which is however many years. So they can use a discounted cash flow or EV/EBITDA multiple to come up with some sort of valuation. The explorers are far more difficult, because they until they can prove that they've got an economic resource. Yes, the gold price is helpful, because it makes if the gold price goes up, then it may make some of their resource economic to mine that previously wasn't economic to mine. But it's only really when they hit a point where it's obvious that they're going to get the project funded in terms of taking it into production, that people can start to look at cash flow methodologies of valuation. Up until there, it's more sort of slightly touchy-feely, and just sort of understanding where they're looking, and especially if they're looking in an area where someone's previously had success. So there's a lot of sort of neurology in the sector where if you can be looking right next to a major deposit, people can get excited. One of the companies in our portfolio is doing exactly that, looking right next to a very high grade operating mine. But if they find something, it's going to be amazing. If they don't, it's not going to be great.
Now, and this is an important distinction to make between explorers and miners and producers, because the explorers aren't operating mines, they're basically exploring for the metal. And one of the things that we hear is hopes that they will be acquired by a major. Last year, we heard a lot of talk about mergers and acquisitions, and there were, quite frankly, some mergers and acquisitions. So just in general, can you talk about the relationship possibly between explorers and the mid-tiers or the majors? And could you also possibly give your thoughts on the mergers and the acquisitions that we've seen, and anything related to that going forward, Simon?
Yeah, absolutely. Well, I mean, gold deposits are becoming more and more difficult to find. And therefore, if a junior has proven up a good resource, then the majors, even though they may pay a slight premium for the asset, given they know that there's already a resource there, and if they're confident that the resource could be a lot larger than perhaps what's already been found, they're prepared to take out these smaller companies, because I think the view is it's less risky to buy an existing resource that you think is going to be much larger than exploring yourself in the hope that you find something. So I think the M&A in the sector is going to increase significantly, but it's very important for the majors to find a resource that's large enough to get them excited. And quite often they're looking for probably 3 or 4 million ounces, or if they can't find that, they want something that's got the potential to reach that sort of number. So I think that especially if you see a junior that has found or got a major discovery which is relatively near to one of the majors, that's going to be on their radar very, very quickly. And I think you'll find the market reacts quite quickly by not only rewarding the junior for the discovery, but potentially putting in some sort of bid premium because the market feels that a major is going to come in and take them out.
Now, but then the flip side to that, I guess, would be there's also the risk that the explorers simply run out of money and are not able to keep going any further, and then that's when the value of the stock could plummet. So those are some of the things that you would be looking into the quarterly reports for, Simon. Could you explain some of the risk with that there?
Yeah, no, absolutely. I mean, I think one of the biggest mistakes that investors make is they get quite excited when they see a large resource. And you can see a company that's got a 1 million ounce resource and you think, oh, that's fantastic. But it's only when you look into it more carefully that you realize that 1 million ounce resource is perhaps over 7 different deposits, none of which are particularly close to one another. So what the company has got in reality is a sort of a reasonable resource, but it's not economic. And what the majors are looking for is if there's a 1 million ounce resource and providing that's in 1 or 2 deposits, then that's quite exciting to someone, especially obviously it needs to be open in different directions, so there's potential for more. But you do need to kind of look under the bonnet and try and understand sort of more about the resource that the company is championing, because it may be great, but it may be a lot of rubbish, really. So you do have to be very, very careful. And you're absolutely right that they can run out of money, and because they're not generating cash as well, that every time they want to raise more money to do more exploration, the only way they can do it is they can issue debt, which is incredibly dangerous, because if they don't find anything, can't pay the debt off, then the company goes bust. But normally they do equity issues, but obviously each time they do an equity issue, they dilute the existing shareholders. So if you're going to be looking at the sector, then what you're really looking for is someone who's got some exploration and you're confident that they're going to find something. So if they do another capital raise, it'll be at a significantly higher share price than you invested in.
Yes, I'm, one of the things that I'm getting from our conversation today is that there's a lot of stuff to keep track of. So, newer investors don't need to get in there and start buying options on the triple leveraged ETFs, right? They need to take their time, dip their feet in the water, feel the water, and look for people such as yourself who can offer that independent analysis and insight to help kind of sort through the different companies to look for what might be potential companies that end up prospering in this next gold and silver bull run, between the ones that are just going to simply run out of cash or dilute their value by issuing shares and things like that you've already said. Now, here's one other thing. I'm also hearing you say that we're talking about different resources around the world. You had also just mentioned Argentina. So one of the things that I'm thinking is that what I'm hearing from you is, you're not just going to want to, like, I'm in the United States. I'm not just going to want to look in the United States for a company that's operating in the United States, because it sounds like this is kind of like a global thing where you need to be looking at companies sort of all over the world because the miners operate all over the world. Could you explain that kind of dynamic there, Simon?
Yeah, absolutely. Well, I mean, you tend to find a lot of the companies are listed either in Canada or Australia on the TSX or ASX, but again, you need to sort of look under the bonnet and see where they're either producing or exploring, And there's a lot of political risk, obviously, in various jurisdictions, but there are certain countries that you have to go for if you want. For example, Mexico is the largest producer of silver. So if you want to have exposure to silver, chances are you'll have a few Mexican companies in your portfolio. Now, the assets will be in Mexico, but the company, chances are, will be listed in Canada or Australia. So you do need to kind of understand the companies and where the assets are, and also the political risk you're taking on, because having a huge deposit in Africa could be significantly more risky than having a huge deposit in Canada or Australia. So you do need to sort of drill down a bit and not take things at face value.
Thank you for that. And so I'm hearing Australia, I'm hearing Canada, the United States. So there's really about 5 or 6 different countries that will be potential areas to look at. The point is, you don't want to just look where you are in your own market. You really need to get a good sense of how the mining industry is working on a global level, because the companies are in fact multinational companies.
Yeah, absolutely. And I think the other thing, especially for us Brits, is you're also getting diversity of the currencies that you're investing in. So, if you've got a proportion of your portfolio in Australian dollars or Canadian dollars or US dollars, there is a natural diversification there as well. So if the pound keeps falling, even if your gold company is doing nothing, you'll probably find you're getting more pounds back than you initially invested because of the exchange rate.
Yes, and that is an important consideration, because the mining company has potential in and of itself. It also has the potential for enjoying the benefits of a rising gold and silver price, and then it also has potential for the play on the currency as well. So there's just so many dynamics that people have to consider, and I think that you would provide a good opportunity to help navigate those dynamics. Now, switching back to gold, away from the miners for 1 minute, if we could, Simon. Gold is hitting all-time highs in various currencies, including the pound, if I'm correct. So could you just talk about gold at all-time highs? We're sitting here right above 1,500, but we've seen a good run here in gold. Do you think that this is going to continue, or are you thinking we're just going to, sit around here at 1,500 for quite some time? Or how do you think the outlook is with gold hitting all-time highs in other foreign currencies other than the dollar?
Yeah, well, you mentioned other than the dollar, which is actually very important, because the price today I think is about 15.20, but if you look at the high in US dollar terms, it was about 18.95 back in 2011. So we're still a long way off highs in US dollar terms. So even though we're highs in many other currencies, I think that gold is priced in US dollars, and I think that if you look at where we are compared to where we've been, it would imply that there is still room to grow. And I think people generally are, if they're buying below a previous high, then they're reasonably comfortable with that. It's only when or let's say the gold price goes to $2,000 or whatever it is, I think that's the point where people start scratching their heads, because they realize they're buying at a price that is significantly higher than a previous high. But I think at the moment we're in a sort of comfort zone, and so it'd be no surprise to me if the gold price continues to go up at least for a while, until some of the issues that we've discussed, trade wars and Brexit and a whole load of other things, have calmed down a little, and there's less need for people to look at safe haven assets.
I think that's an interesting point that you bring up, because a lot of people aren't thinking about that, because yes, in US dollar terms, there's a lot of room to run, but you're talking about something that's really going to affect investor psychology. What happens when gold is at $2,200? You going to sell your gold at $2,200? Because I think that the potential can go much higher. So these are very important insights that I'm gleaning from you today, Simon, and I really do appreciate that. Thoughts on the gold to silver ratio? We were above 90. We're probably right at 90. Gold and silver go hand in hand, and they both have to be mined out of the ground, right? So what are your thoughts on the ratio? Do you see silver outperforming gold? Do you like silver mining companies better than gold, or are you indifferent? Talk to me about that for a minute, if you could there, Simon.
No, absolutely. Well, I mean, I think if you look at the sort of there's a ratio which is basically the amount of gold to silver in the Earth's crust, which I think is about 17.5 to 1. And over the last century, I think it was about 47 to 1. This century, it's been more sort of 50 to 60-ish. But, you know, as you say, well, I think at the moment we're about 88. So we're knocking on the door of 90. And, you know, the only way that ratio is going to change is if either the gold price comes down or the silver price goes up. And, you know, for the reasons we've been discussing earlier, I think there's, I think the gold price is likely to stay at least where it is and, you know, potentially go up. So that would imply there's room for the silver price to go up significantly. And, you know, I think that, you know, a lot of people seem to think that. And, you know, I think also if you look at, you know, we were talking about alpha earlier on, you know, how do hedge funds find alpha? And I think in this market, alpha is your gold price, your silver price. So I think that it is going to attract new money, new investors. And so, yes, I do see that ratio coming down. But, you know, given I see the gold price going up, that means, you know, I think the silver price could go up by more than the gold price. But going back to the portfolio thing we discussed earlier in terms of, you know, the mining stocks, I think you need to have a bit of everything in there, because you don't want to sort of place too big a bet on silver, because that may not happen. Likewise, you don't want to sort of place all your bet on gold, because if silver does take off, you know, you want to be part of that.
And then finally, winding down here today, Simon, you know, there's talk about summer doldrums, and this year has obviously been far from summer doldrums. It's been quite exciting this summer. And, you know, generally speaking, the summer is quiet for news, but, you know, and if people haven't been following the news, they'd have no idea what's going on in this sector. But when I'm looking at moving into the fall, you know, you were mentioning October, if you could just touch on the significance of October, but also we have a Fed that's switched course and is cutting interest rates. So my point here is that there are a lot of fundamental factors that are suggesting that we could still see some movement higher in these metals here into the end of the year. I don't think that this rally is done at all, and I don't think that we're going to linger. So do you see the potential for another possible move here in the fall with all the different fundamental factors that are going on? Just as your closing thoughts today there, Simon?
Yeah, no, absolutely. I mean, I think for a lot of people, gold is sort of certainty in an uncertain world. And, you know, there's nothing that's happening at the moment that is improving certainty for most people on all sides of the pond. And so I think until there's a bit of clarity on, you know, probably the trade war where you are and Brexit where I am and various other things, I think that the gold is going to run. And, you know, I can't see anything stopping it. And we don't know what the Fed's going to do, whether they're going to cut or not. But, you know, that could be a sea change in their strategy. And if they do decide to cut, then, you know, people will have to change their view of the future. And if that means a more risky future, then they're likely to put money into safe haven assets, which, you know, will probably include gold.
And in closing thoughts there, Simon, could you tell us a little bit more about the Brookville Capital newsletter?
Yeah, absolutely. I mean, what it is, it's a weekly newsletter. Not only am I trying to provide people with information, but I'm also trying to educate them. I use something called the bridge system, which is a way of analyzing companies. And what I want people to do is to obviously look at my analysis, but also use the system for themselves. And so enable themselves to see why I perhaps selected a certain idea, and enable them to sort of do the analysis themselves, and you know, also teach them, so if they want to look at other companies, they've got a framework to use to carry out their own analysis. So it's really I think that there's two things going on here. There's one, education, and the other is providing people with not only the ideas, but also with the strategy to implement those ideas.
I really like the idea of that system, because that to me is speaking about discipline. And I think discipline is very important, and it's going to be very important moving forward as this bull market continues. Simon Popple, I would like to thank you for joining us today on Silver Doctors.
Thank you very much. Really enjoyed it.
Getting interested, learning how to trade, and doing all that stuff.
We haven't even really kind of hit the ground, you know what I mean? And so when we hit the ground, that could easily be 100, 200% average. But someone said to me, never love anything that can't love you back. I think if you've got the discipline to do that, you could do phenomenally well. But a lot of people they'll ride it out, make 5-10 times their money, and then they'll just ride it all the way back to the ground. And
that was my problem. Like, I didn't understand at the time profit taking. I didn't even know what that was, right? So, and when you say take it out, see, I would take it out and put it in the gold and silver, right? Just actual metal. So I would take out profits but I had no idea. People were like, "Oh, you got to sell some and then buy when it dips." I'm like, "What are you talking about? It's still going up." Then,
Exactly. and then it comes back down. You go, "Well, it'll go back up again," and it doesn't. And then next thing you know, you're kind of you're pretty upset about life.
Doubling down, and it's going to go back. So.